Welcome! You're viewing the video version of the Pirls Stock Market Commentary featuring the proprietary bull-bear point and figure market breadth summary chart for May 15th, 2016. Market breadth. With this past week's market fractional decline, our bull-bear point and figure ratio at 1.08 rose from 1.07 last week, once again barely remaining within bullish territory. The total count of securities in bullish or bearish patterns decreased 4% to 2,924. The count of bearish stocks decreased 4%, while the count of stocks in bullish patterns decreased 3%. The Pirls P&F Market Breadth Summary Chart shows us a market now 10 weeks in bullish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the email version of the Pirls Stock Market Commentary on a weekly basis, free of charge, simply enter your email address in the space provided. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 201 points for the third decline in 13 weeks. At a positive 103.74 points, it has now fallen below the November 2014 and the March 2015 highs, and continues below the four remaining tops within the last 3 years, and it continues above all six bottoms below minus 100 in the last 3 years. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 3 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in neither accumulation nor distribution mode on lower average daily volume. Momentum. Now at minus 85.02, the CCI 20 daily rose from minus 136.60 last week, continuing outside the plus or minus 50 range for a valid zero-line reject short entry signal. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 2 weeks ago, while the daily CCI 20 began a Woody's downtrend 1 week ago. Having begun a Woody's uptrend 1 week ago, the CCI 20 weekly rose to a positive 21.66 from positive 15.23, and within the plus or minus 50 range signals a valid zero-line reject long entry signal for next Monday open. We will continue following the results of this trade simulation in next week's commentary. Industry rotation the last 2 weeks. Only 2 of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs on top, tech mixed. Bullish, REITs continues in the top 5. Comp Tech has entered the top 5. Semis and brokers have left the bottom 5. Gold and silver have left the top 5. Oil services has entered and leads the bottom 5. Bearish, computer hardware and disk drives continue in the bottom 5. S&P Retail has left the top 5. Focus this week from www.charleshughesmithblogspot.com. The Destabilizing Consequences of Globalization. Some key points are the following. It is not possible to coherently discuss the new normal economy without discussing financialization, the substitution of credit expansion and speculation for productive investments in the real economy and its sibling, globalization. Globalization is the result of the neoliberal push to lower regulatory barriers to trade and credit in overseas markets. The basic idea is that global trade lowers costs and offers more opportunities for capital to earn profits. This expansion of credit in developing markets creates more employment opportunities for people previously bypassed by the global economy. In reality, trade is rarely free, in the sense of equally powerful participants choosing to trade for mutual benefit. Rather, quote, free trade, end quote, is the public relations banner for the globalization of credit and markets that benefit the powerful and wealthy, not the impoverished. Financialization and mobile capital exacerbate global imbalances of power and wealth. Trade is generally thought of as goods being shipped from one nation to another to take advantage of what 18th century economist David Ricardo termed comparative advantage. Nations would benefit by exporting whatever they produced efficiently and importing what they did not produce efficiently. In a world dominated by mobile capital is the comparative advantage. The mobility of capital radically alters the simplistic 18th century view of free trade. In today's world, trade cannot be coherently measured as goods moving between nations, as capital from the importing nation often owns the productive assets in the exporting nation. If Apple owns a factory or joint venture in China and collects virtually all the profits from the iGadgets produced there, this realistically cannot be captured by the simple trade model described by Ricardo. Once these factors are considered, it's been calculated that as little as $10 of the value of every Apple product actually ends up in the Chinese economy. Virtually all the profit flows to Apple in Cupertino, California, not to joint venture partners in China or the workers who assembled the components in China. In today's globalized version of, quote, free trade, end quote, mobile capital can arbitrage the varying costs of labor, currencies, interest rates, taxes, environmental regulations, and political favors by shifting capital between nations. In the global economy, trade is not conducted between equals. Those with access to the unlimited credit of financialization can outbid domestic capital for assets, labor, and political favors. Local assets priced for the local economy where credit and cash are both limited are snapped up on the cheap by global capital and sold for immense profits. As the over-indebted default, their land and other possessions are confiscated by offshore lenders, further impoverishing the local populace and enriching global capital. Where is the, quote, free trade, end quote, in a world in which the comparative advantage is held by mobile capital? And what gives mobile capital its essentially unlimited leverage? Central banks, which issue nearly free money to banks, which funnel the cash to corporations and financiers, who can then roam the world, snapping up assets and arbitraging global imbalances with low-interest money. There's nothing remotely free about trade based on capital flows generated by central bank liquidity. The scale of global capital is difficult to grasp. Trillions of central bank issued dollars, euros, yen, and renminbi are sloshing around the global economy, seeking low-risk profits. Once goods and services are priced globally, local supply and demand no longer set the local price. As a result, measuring inflation and deflation locally is meaningless in a globalized economy. Who benefits over the long term from the permanent instability and boom and bust cycles of this arrangement? Only those close to the credit spigots of central banks. Thank you for tuning in for this week's Santu Pirls Stock Market Commentary, featuring the proprietary bull-bear point and figure market breadth summary chart, compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a productive and prosperous week coming up, and wishing you true success.